Okay, please come back to this wonderful question number 39. First answer we have discussed why it is a subsidiary. We have discussed power over the investee, exposure to variable return, ability to use its power to affect those returns. But in this question now keep in mind the subsidiary Gamma will have 60% NCI because we have only 40% share. So NCI of Gamma will be based on 60%, and of course NCI of Beta will be 20%. That will be required here for calculating the NCI interest in the profit and NCI interest in the total comprehensive income. Okay. So now let us start revenue. For revenue, we'll go to working note 1. So in working note 1, you will take on your calculator 9 by 12 of Gamma you do first, because Gamma was acquired on 1st of July. 9 by 12 into 2,92,000. Then you add alpha 4,20,000. Add beta 3,35,000. So how much it comes to? 9 lakh? Okay, so right here 9,74,000. Okay. And I'm going to make two adjustments immediately. Sale of component by alpha to beta. That intercompany group transactions we will eliminate, which is included in the revenue figure. So you write down how much is the sale made by alpha to beta. Is it 30,000? 30 million rupee in thousand, write down 30,000. And how much is the sale value of that machine which was transferred by alpha to beta? 16,000. See this note? Is it there 16,000? So what is my revenue to be shown in consolidated financial statement? 9 lakh how much? 9,28,000. 9,28,000. So we will come to main page. 9,28,000. One figure we will lock. Okay. Now understand here in this problem, to just simplify, cost of sale we will write balancing figure. But there is no necessity. You can also prepare cost of sale working note and then gross profit balancing figure. Gross profit working note 2. So first we will add the gross profit of the three companies, but Gamma we will take 9 by 12. So take your calculator. Gamma's gross profit is 1,24,000 into 9 by 12 plus beta 1,43,000 and plus alpha 1,80,000. So what is the gross profit of these three companies? No, try again. 287 500. Alpha is 1,80,000. No. One lakh 80,000 full. Beta 1,43,000 full. Which question you are referring to? 180 plus 143 and plus 9 by 12 of 1,24,000. Give me the correct answer. 4,16,000. Is it right? So the answer is 4,16,000. We'll come back to this working note later, as and when we'll come to the adjustment. Some adjustment I have already done. Next line in your question, distribution cost. Now there is no adjustment in distribution cost. So again carefully take your calculator. 20,000 plus 16,000 and 9 by 12 of 14,000. 46,000? 46,500. Okay, distribution cost is over, revenue is over. Now next is administration expense, working note 4. So let us come to working note 4. If you have many adjustments, then you can write in a separate working note. For the time being, what you do, just take the 2 figures full and 1 figure 9 by 12. Administration expense, take your calculator. 40,000 plus 32,000 and plus 9 by 12 of 28,000. Is it 93,000? Right, 93,000. And the other adjustment we will discuss later. 93,000. Wonderful. Next, contribution to retirement benefit plan. Note number 5. So what you do, you come to one actuarial gain and loss working. This contribution which they have paid will actually be adjusted in the actuarial gain and loss working note. So right here 5,000. I'll explain it to you again when we'll come to this. Okay, write in bracket. See what is actuarial gain or loss. Opening net liability we will take. To that we'll add current service cost, finance cost minus contribution, and then we'll compare it with the closing net liability. If the book value does not tally with the closing net liability, then the difference is actuarial gain or loss. Refer IAS 19 for this. We'll discuss again, we'll come to this. After the contribution to retirement benefit plan, now come to finance cost. Now working note 5. Finance cost, working note 5. You again take the calculator. 20,000 plus 15,000 plus 9 by 12 of 12,000. How much? Is it 44,000? Right here, we'll come to this because there are two adjustments. One relating to deferred consideration, one relating to retirement benefit. So have you written? Finance cost 44,000. Next is investment income. Come to this main page only. And this is simple, so I'll just adjust here only. Or you want to make a separate working note. Total investment income is 33,000. 80% of 30,000 which was paid by beta received by alpha will be eliminated. 20,000 dividend which was paid by gamma, 40% of that received by alpha will be eliminated. So dear student, tell me what is the net income from outside world other than group companies? Any answer? Just 1,000 only. Now see, in this, in order to avoid confusion, some are expense, some are income. So expense you write in bracket and income you write positive. Otherwise, afterwards you will add this also. Okay, continue. What is the next item? Profit before tax that we will calculate. Income tax expense. There is a working note number 8. Income tax expense. So first you just add these three numbers: alpha 32,000, beta 20,000, and 9 by 12 of gamma. So dear student, how much it comes to? 60? Is it 64,000? Right, 64,000. Next line. Profit for the year. That is 96,000, 1654. Don't do anything. Other comprehensive income. And under that other comprehensive income item that will not be reclassified to profit or loss, under that gain on property revaluation, note number 7. So let us come to note number 7. Immediately complete it. It is the policy of Alpha Group to measure freehold property using fair value model, and all freehold property were revalued on 31st March 14. Beta leases all of its properties, and all of Beta's property leases are operating leases. The gain shown in the financial statement of Alpha and Gamma do not take account of deferred tax implication of revaluation. And what is the tax rate in this problem? 25%. So that means there is a small error they have committed. If you revalue the property, so a book value will exceed the tax base. Is it right? Book value will exceed the tax base. So this will give rise to deferred tax liability. So first you tell me alpha plus gamma. Now don't take 9 by 12 here. This adjustment was made in the post acquisition period. So this note is also written. How much it comes to? 37,000. And what is 25% of that? 9250. So what is the net amount? 27,750 is right. Now where will you write this 27,750? In this main page. Gain on property revaluation 27,750. Do we have a working note on income tax also? Yes. How much was the deferred tax adjustment here? 9250. This we have already adjusted in the amount itself. So this won't be again presented in the deferred tax calculation. Is it right? This deferred tax is included in this 20. How much is that? 27,750. No need to write it again because it is already deducted there only. Okay. So now it will directly go to the balance sheet. It won't affect profit and loss account now. Deferred tax on OCI item is adjusted in OCI, and that working note 8 income tax expense is for P&L account purpose. So this won't come in the profit and loss account. Of course, this will go to balance sheet if you are preparing the balance sheet SOFP. Okay. So this is your P&L account. Items are over. Total comprehensive income I will calculate. Now come to this working. Impairment loss. Have you computed this impairment loss? How much was that? 10,000? So write here 10,000 in bracket. Impairment loss will be charged to cost of sale. Nothing is mentioned here about the deferred tax, so ignore it. Okay, only for those items where they are mentioned, we'll discuss the deferred tax. Now we'll come to adjustment number 1, which actually we have just now completed. Then acquisition of Gamma. On 1st July 2013, Alpha acquired 40% of equity capital of Gamma. Purchase consideration was comprising of issue of equity share cash payment of 65.34 million. This we have done. How much finance cost we have recorded? 4050. Here 4050. So this we have done. Okay. The other 60% share are held by a wide variety of investors, none of whom owns 0.5% individually. This paragraph we have discussed. It means it is a subsidiary. Now, when reviewing the net asset of Gamma on 1st July 2013, directors of Alpha ascertained the following. Property of Gamma had been revalued on 31st March 13 and there was no significant difference between their carrying value and their fair value. So ignore. The plant and equipment of Gamma had a carrying value of 1st July 2013 70 million, fair value 78 million, estimated useful life was 4 years, zero salvage value. So this additional depreciation we will adjust in gross profit. How much amount we had written here? You have written this figure 1,500. 1,500. And similarly, how much extra amortization of Gamma's development project you have written here? 300. Now these two items will give deferred tax. Now here in this example, it will give rise to DTA. Sure. Why? So come to this working note on DTA, income tax expense, deferred tax consolidation adjustment. First you come to this line, fair value adjustment. Fair value adjustment, 25% of 1,500 plus 300. How much is that? 450. 450. Impairment of goodwill, right here dash, outside the scope. Next line, on 1/7/13, Gamma had a contingent liability which it did not recognize in its own financial statement. That is good. The contingent liability still existed and was still unrecognized by Gamma at 31st March 14. That is also good. Separate financial statement we don't recognize. On 1st July 13, Directors of Alpha believed that contingent liability had a fair value of 16 million. So for business combination purpose, they would recognize it. 16 million on 31st March 14, they assessed its fair value at $12 million. The reassessment was due to a change in circumstances after 1st July 2013. That means it is not a measurement period adjustment. It is not a measurement period adjustment. What is that measurement period adjustment? In case if you find any change in fair value within 1 year from the date of acquisition, but due to facts and circumstances existing on the date of acquisition, then we'll go back, make adjustment, and the contra effect goes in goodwill. But this is due to a change in circumstances after 1st July. So this will not be a measurement period adjustment. So this is to be adjusted in our profit only. So either we can adjust in administration expense, or we can show it as other income, reduction in liability, or we can adjust in cost of sales. So what we have done, we have adjusted in administration expense. And you write a note, it's already written, typed in your notes. Alternatively, one can show it as other income or adjustment to cost of sale. How much is that? 4,000. What about the deferred tax implication? It should come. Why? Write a note that deferred tax implication on contingent liability is ignored. Write a note. Write a note. How much? 4,000 into? Write a note. Now, there is no harm. Write a note. Deferred tax. Your liability is reduced. Because we don't know how much is the tax base unless we know whether it is allowable, not allowable, etc. Okay. So we don't know the background of that contingent liability. You can write a note. Deferred tax on contingent. See, earlier what you must have done, liability 16,000, tax base will be 16,000. Suppose the tax base is same, then there is no need to calculate the DTL. Then again you assume that it is tax base will also reduce by 4,000. How? Just like this 16,000 was created and it got reduced, the tax base can also get reduced because you are assuming that this liability will be paid. It's a contingent liability. So one can assume the tax base also is the same and then you ignore it. Write down. Deferred tax on contingent liability is ignored. Details are not available. Deferred tax on contingent liability is ignored. Okay, now we'll come to Our next point number 3, depreciation and amortization charges should be presented as part of cost of sale. Done. Trading between alpha and beta. This also I think we have discussed partially. Trading between alpha and beta. First you see this sale of component adjustment. Point number 1 is sale of component. Very easy. Alpha supplies a component to beta, which is used by beta in the production process. Alpha marks up its cost of production by 1/3 in arriving at the selling price. In the year ended 31st March 14, the revenue of Alpha included $30 million in respect of sale of this component that I have adjusted. On 31st March 14 means closing stock. Inventory included 6 million. On 31st March 13 means opening stock. Inventory was 4.4 million in respect of unsold component purchase from Alpha. So you want to write two separate line or one line only? On opening closing stock unrealized profit will increase the cost of sale and reduce the gross profit. Is it right? An unrealized profit on opening stock will reduce the cost of sale and increase the gross profit. So you can either write separately or you can just take the net difference. Net difference is 6,000 minus 4,400. Okay. And take 1/4. Why 1/4? 1/3 of cost is 1/4 of selling price. So net increase in the closing stock is 1,600, which is due to intercompany transaction into 1/4. How much is that? 400. Very good. Positive or negative? Gross profit will reduce. For unrealized profit, gross profit will reduce. Now there is a note in the last line that this will be treated as temporary difference for computing deferred tax. So go to the deferred tax calculation. Unrealized profit on component. Parent's unrealized profit on component is proportionate unrealized profit on component 25% of 400. 100. Okay. Then same thing for this also. Point number 2. During year ended 31st March 13, Alpha manufactured a machine which was to be used by Beta from 1st April 13. The cost of the manufacture totaled $12 million. On 1st April 13, Alpha transferred the machine to Beta for an invoiced price of $16 million. So this is 16 million. And what was the cost? 12 million. So the gross profit made on this item was 4,000. On 1st April 13, this we have read, Beta included the machine in its PPE, and they have included as PPE and depreciated the machine over its estimated useful life of 4 years. So 1,000 has been depreciated. So the unrealized profit now included in the machine will be 3/4. 1/4 got depreciated. 3/4 is still lying in the value of that machine. So how much is this net amount calculated by you? 3,000. Deferred tax on 3,000. Unrealized profit on machine. 3,000 into 25%. Is it 750? No, this is my total liability, no? So from liability I am adjusting the asset. So it should be negative. Carrying amount is, we are eliminating the unrealized profit, but this profit is already offered for taxation. Profit is already offered for taxation. We are eliminating the profit. So you will save tax in future. As you will provide more depreciation, you will save more tax in future. As you will charge the inventory to cost of goods sold, you will save taxation in future. So both are tax saving items. And this is my liability and this is my total payable. So therefore I have to reduce it. Accounting wise, this will go to debit side of P&L account and this too will go to credit side because they help me to save the taxes. Okay, continue. Point number 5. Now your favorite, defined benefit, retirement benefit. So continuously focus on working note 10. Certain senior executive of Alpha belong to a defined benefit retirement benefit plan. In the financial statement of Alpha, the contribution paid into this plan have been shown as an expense in the statement of profit or loss and other comprehensive income. Relevant information regarding this plan is as follows. The pension liability was 60 million on 31st March 2013. So tick mark 60 million, opening net liability part. The liability increased to 68 million, tick mark 68 million, closing liability on 31st March 14. The pension asset was 40 million, tick mark 40 million on 31st March 13, and this increased to 46 million at the end of the year. So this we have ticked mark. Contribution paid I have reduced. The current service cost was, so what is the opening net liability right here? 20,000 and closing net liability 68 minus 46 is how much? 22,000. This is they have given. Now tell me, current service cost is 4.5 million, 4,500. This will be transferred to P&L account. Under which head? Admin expense. Because it's mentioned in that note, these expenses are shown as admin expense. So right here 4500. Back to this working note. Number 10. The Alpha's borrowing rate is 9% per annum. On that date, the market yield on corporate bond was 8% per annum. So you have an opening net liability of 20,000. So on 20,000 at 8%, how much finance cost on net liability you will recognize? 1600. And 1600 we will also add here in finance cost. Working note 5. Working note 5. Now back to this working note 10. So what you do, first you draw one line here. This is my book value of the net liability right now. 20,000, 4,500, 1,600 minus 5,000. How much? 21,100. Very good. This is book value. But this is your fair value at the end. Net liability has gone up by 900. Is it actuarial gain or is it actuarial loss? Loss. What about the deferred tax? Now here they have said ignore. Okay. So where is actuarial loss? Where should I write it? So come to this main page. Actuarial loss on defined benefit plan. Working note 10. Amount write down 900. In bracket write easy for calculation. Okay. Adjustment number 6 we have done. 7 also we have done. 7 also we have done. 6 was dividend, 7 was that revaluation of freehold property. Now last adjustment, hedge of the future property purchase. On 1st February 14, Alpha entered into a firm commitment to purchase a property on 31st May 14 for 40 million euro. In order to eliminate the impact of currency fluctuation, on 1st February 14, Alpha entered into a contract to purchase 40 million euro for 48 million euro on 31st May 14. The contract had no cost and Alpha did not record it in the financial statement for year ended 31st March 14. On 31st March 14, the contract had a fair value of 3.6 million financial asset. Alpha uses hedge accounting whenever permitted by IFRS. Where a choice of hedge accounting method exists, Alpha uses cash flow hedge accounting. So in cash flow hedge accounting, what we do? We transfer the change in fair value of derivative to reserve through OCI. So on the screen, item that will subsequently be reclassified to profit or loss under that cash flow hedge, write positive number 3600. Okay. Now I need few figures to complete this answer. So first you tell me gross profit. Anybody gross profit? 400,800. Okay. So we'll go to the main page. 400,800. Right here in gross profit. And then you write down the balancing figure COS. How much is COS? 527. Right here 527 200. Right in the column 527 200. Okay. Now can you just go to working note 4 and give me the administration cost figure total? Huh? Let me check. This is a negative figure. 93,500. Right, 93,500. Administration expense 93,500. One is income, so that will be reduced. Finance cost, go to working note 5. Take the total of the three numbers. Total of the three numbers. Anybody? 49650. Very good. 49650. Now wait a minute. These numbers you put in bracket. Distribution cost, admin cost, finance cost, cost of sale. Okay, now take your calculator and you have a gross profit of 4,800,000 minus 46,500 minus 93,500 minus 49,650 and plus 1,000. So this gives me profit before tax figure. How much? 212,150. Right. Income tax expense. Go to working note 8. Working note 8. Take the total carefully. 64,000 is the total expense, but there are 3 credit to P&L account. So the net tax expense would be 62,700. Is it right? 62,700. 62,700. Come to this 62,700. So what is profit after tax for the year? 149. Okay, so this is an important figure, you got it. And then we have other comprehensive income item that will not be reclassified to P&L account, gain on revaluation, actuarial loss, item that will be classified to P&L account, cash flow hedge. Now take your calculator again, type 149,450 plus 27,750 minus 900 plus 3600. So this will give me total comprehensive income for the year. Profit after tax, this figure you have to take, and plus minus plus. Anybody? 179,900. Okay. Now just wait for a minute. I have to now divide the profit after tax, this figure, between parent and NCI. And then I have to divide this total comprehensive income between parent and NCI. Okay. So for that, we'll go to a working note number 11. Because we have to take subsidiaries profit, and then whatever adjustment was made in subsidiaries profit, that we will adjust, then we'll come to the profit that needs to be shared. So on the screen, what is the profit for the year for beta? Go to question book. Profit after tax for the year. In your question, can you see it is written profit for the year 60,000 in the center? Write 60,000 here. Now, in case of beta, there was an impairment of goodwill. How much was the impairment? Was it 10,000? Is there any other adjustment in beta's profit? Now you will say, what about this gross profit adjustment? This is the sale by parent to subsidiary. This is also sale by parent to subsidiary. Yes, this extra depreciation will affect, but not beta, gamma. Okay. And this impairment of goodwill will affect beta, that we have done. Right? So these two items will affect parent's profit. These two items will affect gamma's profit. This will affect beta, that I have done. Okay. Even this administration cost, etc., that we have done will affect parent company. This deferred tax consideration, finance cost on defined benefit plan will affect parent profit only. So mostly in such question they give adjustment in parent's book, but you have to check in whose book these figures are getting affected. If subsidiary, then it will come here also. Now we'll come to this profit after adjustment, 60 minus 10, is it 50,000? Now 20% NCI share in first subsidiary. So that is 10,000. Write 10,000 here. So 10,000 is a share in the profit of beta. Now gamma. First, in case of gamma, be careful. We'll take 9 by 12 of the current year profit. Current year profit, can you see 54,000 in the third column, last third line? Into 9 by 12, 40,500. And then there are fair value adjustments. 1500 plus 300. How much is that? 1800. And on this fair value adjustment, there was a deferred tax adjustment also. 450. Deferred tax adjustment 450. So take 40,500. Profit will reduce because of extra depreciation. Profit will increase because of deferred tax credited to P&L account 450. The same 450. So what is the net amount in the next line? Anybody net amount? 39? Oh, wonderful. 39,150. What is the NCI in this subsidiary? 60%. 23? Sorry. 23,490. Right, 23,490. 490. And now total of both the NCI 33,490. So 33,490 write down. 33,490. My handwriting is not that bad, but this computer has a small problem. Okay. So 33490. 33490 on the screen. So profit attributable to NCI 33490. So what you do, wait a minute. You take this total profit 149450 and minus 33490. So that will give you profit after tax attributable to parent. Anybody? 115960. 115960. Okay. 115960. Okay. Now, what about the total comprehensive income attributable to parent and NCI? On the screen, understand. In other comprehensive income, we have these three items. This 3600 belong to whom? Parent. It was the adjustment in parent book, cash flow hedge. This 900 actuarial loss, this was adjustment in whose book? Parent's book, ignore. And out of this 27,750, this is a revaluation gain. This has two parties involved. One parent alpha and one gamma. 12,000. Gamma is 12,000 before tax, and after tax 12,000 minus 25%. So what I'll do? Only for the gamma share. Only for the gamma share will adjust in NCI. Is it right? So on the screen, kindly come to, is there any working note on this? Yes, it should be. Non-controlling interest in total comprehensive income. Last working note, I think. Is it there? First you write NCI share in the profit after tax. How much was that figure total? 33? Okay. 33,490. 33490. You don't have to struggle full. That figure you take. In OCI only identify subsidiary item. So subsidiary has only one item, gamma, property revaluation. Property was revalued upward by 12,000 minus 25% deferred tax implication. So either you write 12,000 minus 25% or you write 12,000 into 75%. So that comes to 9,000 and into 60% NCI share in gamma. How much is that? 5400. So now you add this number. How much you get this? 38890. Okay. So this is my handwriting, 38890. That is okay. Now come back to the main answer. So write here NCI share in total comprehensive income. 38890. And balancing figure here, owner of the parent. How will you write this number? Take this 179,400 minus 38,890. So it comes to 141. How much? 179,900 minus 38,890. 141,010. Done. And the total of these two also you can write and close. 179,900. 179, how much was that? 900. Okay. 179,900. 179,900. That is the last line. Now you read the problem, read the solution. If you have any query, you can ask. Done. So which is the next question now? 40. Come to question number 40. 40 can be up to 40 marks. Okay. Alpha holds investment in two other entities, beta and gamma. The statement of profit or loss and other comprehensive income. So this time again you have given statement of profit and loss and other comprehensive income and summarized statement of changes in equity. One more format will prepare this time. Statement of changes in equity of the three entities for the year ended 30th September 2014 were as follows. So what is the year ending date? 30th September 14. Revenue, cost of sale, gross profit, distribution cost, administration expense. One more new item you will learn, redundancy and reorganization cost. IS 37, provision for redundancy and reorganization cost. Investment income, finance cost, PBT, income tax expense, profit for the year, other comprehensive income, item that will not be reclassified to profit or loss. Under that we have gain on financial asset designated at fair value through OCI. Which standard deals with financial asset designated at FVT OCI? IFRS 9. Mostly 9. Okay. Next line. Total comprehensive income. Summarize statement of changes in equity. Opening balance on 1st October This is separate financial statement. Okay. Then comprehensive income for the year. This they have copied from previous line 52,600, 30,000 and 34,700 minus dividend paid. Now underline the date of dividend payment 31st December 2013. When was the dividend paid by all the three company? 31/12/2013. And then closing balance on 30th September 14. This is the movement of their statement of changes in equity. Note 1. Alpha's investment in beta. On 1st October 2001, long back, okay, Alpha acquired 75% of equity share of beta. This gave Alpha control over beta. On 1st October 2001, 1st October 2001, the net asset of beta had a fair value of 80 million, underline. On 1st October 2001, what was the net asset of beta? 80 million, means 80,000. Is it right? And now if you see the statement of changes in equity middle column, they have written balance on 1st October 2013, 1,40,000. Can you see that 1,40,000? Middle column, last fourth line. Which means till last year, there has been an increase in net asset by 60,000. There has been an increase in net asset by 60,000 because this will help me to prepare the opening SOCI figure. Consolidated opening SOCI will include parent share in this, NCI share in this, because that is the change in the post acquisition period till the beginning of this year. So that is the use of this line. None of the assets and liabilities of beta which existed on 1st October 2001 were still assets or liabilities of beta on 30th September 13. On 1st October 2001, Alpha measured NCI in beta at a fair value of 22 million. So which method of NCI valuation they are using? Fair value. Okay. See, if it is fair value, in case of any impairment loss, they will also participate in the impairment loss of goodwill. Is it right? So NCI share on the date of acquisition was 22,000, and then you will also add the share in this 60,000 so as to get the opening balance of NCI in the consolidated financial statement. Is it right? Are you following? Goodwill on consolidation was 18 million. No impairment of goodwill on acquisition of beta was necessary up to and including 30th September 2013. So till last year, no goodwill impairment. But beta has 4 operating segments which are also CGU for the purpose of impairment review. On 1st October 2001, goodwill on acquisition of beta was allocated between these units on the following basis. Now they have themselves given the allocation of goodwill 8433. Is the total matching to the 18 million? Yes. So what you will do, like one previous problem, you will take the carrying amount, add goodwill, take total, compare it with recoverable amount. If recoverable amount is less, then impairment loss. On 30th September 14, carrying amount of net asset excluding goodwill and the recoverable amount of the 4 CGUs of beta were as follows. So carrying amount, recoverable amount, any impairment of goodwill will be charged to cost of sales. Is it right? So while presenting in the Profit and loss, you will adjust it in cost of sales. Now we'll continue tomorrow. First, we'll complete reading this question, which is still 2 pages pending, and then solve. You can try and come.